Hi everyone, my name is Jon Deluce. I'm the CEO and founder of Abitibi Metals, trades on the CSE under the ticker AMQ. We're developing the B26 deposit. Very excited to announce our updated resource yesterday. And again, we've been able to accomplish a lot over the last year, which I think was really a transformational year between the people that we brought together, the world-class drill results, amounting to us delivering an updated resource well ahead of schedule, hitting our 25 to 30 million ton threshold for 2026 at the very beginning. So we're very excited about all the factors coming together.
Good to see you. So actually, John, you had a good run up at the end of last year and continues well into this year as well. Obviously, the resource coming out is good news. But maybe before we dive into some of those numbers, can you just talk through and remind people, look, what have you set out to do? And maybe what are some of the things that you set in place in 2025, which is going to allow for this kind of growth profile you're looking for in 26?
Yeah, I think really our goal at the company and what we set out to do is we wanted to build a leading Quebec junior mining company. And how do you set out doing that? You got to first find an asset that's able to attract world-class talent. That's what we did in 2023 by optioning the B26 deposit off of the Quebec government subsidiary SOQUEM. We're in the process of exercising our option agreement to earn our full 80%, which we anticipated to be complete over the next month, 5 years ahead of schedule. But that was a basis. We started with that asset in 2023 in a market that wasn't quite there yet for copper gold. We're now in the market that we're in today. The market's there, and we're seeing takeovers, and the interest from the producers are there. But what have we done to de-risk for ourselves and our fellow investors during that time? We saw the vision with the asset, but the right asset in the wrong hands is worthless. So we were able to attract a world-class team led by Louis Gary P, VP of Exploration, with his track record with takeovers in the Abitibi, in addition to working with large-scale producers on VMS mines in Peru, Laurent Estache with his track record at Agnico and as a fund manager, and most recently David Bernier, who is the COO of Foran, that built the McIlvenny Bay deposit from PEA through to commercial production. Very similar high-grade VMS deposit that was just bought out on Monday for what was $4 billion and then continues to go through towards closing. So I think what we set out to do, to summarize, be a leading Quebec junior mining company in a field that a lot of the serious developers have been taken out over the last year, and really drive the exploration, drive the development, start into early stage permitting baseline, because that's how we drive value and produce something that a major producer wants to get involved with.
Okay, understood the plan, understood the game plan. Obviously, your goal for this year is to kind of show that you can continue to scale this, and it's something that may be interesting to a major potentially, or be able to kind of get after it yourself. So, with regards to the resource numbers, I mean, that most recent press release, maybe give us some of the top line numbers, and I'm going to dive into some questions about that.
Yeah, so since optioning the project, we're up over 125% in terms of tonnage growth. Looking at 13 million tons indicated at 2.1% copper equivalent, 12.3 million tons inferred at 2.2%, and the growth in this resource has come from inferred. One of the key questions that we had from some of the producers that have reviewed the project was, how big can this get? We can infill this later. How big can this deposit get? And could this be a Salve size deposit? So our thesis has been this could very well be a 30 to 50 million ton deposit. I think this gets us another benchmark up in terms of credibility around that at a time that we're taking aggressive step outs and doing regional work as well. So I think that was our goal. And one thing to note is we didn't cherry pick the commodity or precious metals prices in this update. $2,500 gold, $30 silver, $450 copper, $135 zinc. But the key thing to note is if this was mined today and we were mining it at spot prices, across both categories, this would be closer to 2.55% copper equivalent, which shows the torque within the deposit. So I think we've grown it from our last update, 18.5 to 25.3, maintaining the grade. If we look at the cutoff at this and drop it by $20 per ton NSR, this is already above 30 million tons. So I think we've been able to demonstrate something using a conservative baseline that sets the stage for a lot further growth, especially with our 40,000 meter drill program underway.
Okay, so there's a combination in terms of the drill program that's underway at the moment, and obviously the stuff that kind of made it into the resource. There's a lot of kind of geological expansion. There's some model tightening as well. How repeatable is this kind of growth rate? How effective can you be with kind of the future, the rest of the drilling here, any kind of future drilling that you do?
I think we've had consistent growth since we've optioned the B26 deposit. And again, it's completely open given who our partners were that we bought it off of, which is the Quebec government subsidiary SOQUEM. So I think our track record in terms of growth over the last 2 years, I think has been strong. But it's also been at a discovery cost of 2.5 cents per pound copper equivalent, which is also, okay, have we spent hundreds of millions of dollars to do this, or have we actually managed the capital well along the way? So I would put us up against any of our competitors to try to find somebody that's done it more cost efficiently. But at the end of the day, can we grow this further? Our downhole geophysics supports it. Our step out drilling in the last program supports it. What our larger scale expansional targets to the west supports it. And I think time will tell when we now have the capital to answer those questions with our 40,000 meter drill program this year. I also think there's easy rooms for improvement, like Dave Bernier reviewing the deposit, for example. The deposit as of today is stated at a 2.8 density factor. When we look at strainer systems, massive sulfides, this is understated. We didn't have the density data to support an adjustment for this resource, but we anticipate that coming into the next resource. So between growth on commodity prices, growth through the drill bit, growth through advancing our mine plan and model to bring into the resource, I think that there's still a lot of upside for growth here.
Right, and so, okay, will that come from the existing kind of defined mineralized zones, or is part of this also going to come from brand new domains? In which case, can that kind of cost profile stay the same?
So I think it'll be a combination of both. I think in 2025 and in the drill results from last month, we demonstrated that we picked areas within the resource that we felt the grade was understated, tonnage was understated, and we hit pockets in large gaps in the drill grid that has improved what was stated there. So I think we call it our resource improvement drilling, because it's not just strictly infill. We're taking large gaps in the drill grid and we're converting to higher grade, and in some areas broadening the zones. So that's one side of it. Second side of it is whether it's near surface down to where we're now at 1,000 meters vertical, we're pushing out that system to the west. Consistently, whether or not we're hitting high grade and high widths or lower grade and lower widths, we're consistently seeing the alteration zone everywhere we drill on the western side of the deposit, which tells us the grade and widths are going to vary from hole to hole, but the system is there, which is extremely important. You look at like the early days of the Larone deposit on the Cadillac break, and it was one system that they found another one. But the key thing was the system still there. And as long as the system is still there, we're very confident in the growth profile across the western extension of the deposit.
Right. So we're just saying with the current drilling. So that kind of came from vertical extension and horizontal extension. Yeah.
Yes, that in some areas
mineralized on the
exactly.
road. Right.
Yeah,
so this. Okay. So how do you then sort of allocate capital and drills to maybe looking at brand new domains then?
One of the developments, like we have the 80% of the resources, the copper gold, 20% is the zinc silver. One of the exciting things is the zinc silver is situated on the eastern side of the deposit, and we started for phase 3 drilling from the south to the north. The VMS lens is confined to the eastern side of the deposit as of today, but the exciting thing in our deeper drilling that we use to expand the copper gold zone is we're starting to see the reappearance of the zinc silver lens. I think it's up to 500 or 600 meters away from the known zone. So it's a good example of the potential to see brand new parallel lenses, whether or not they're continuances of the existing ore body, or they could be new lenses as we drill this out to the west. So I think extending the known zones plus the potential for discovery whether or not it's in the proximity of the deposit or on our property-wide targets that we're drilling for the first time this quarter.
Interesting. I think last time we talked, John, you talked about these conceptual mine shapes that you were after, and how much of the inferred is sort of sitting within those kind of mine shapes at the moment? I know you kind of got a high ratio there in terms of M&I, but give me a sense of what you're seeing in terms of building that kind of geological confidence, as it were.
So our last internal scoping study that we did, again, it's not at the level of PEA, but we use that to influence our drill strategy. We had cut our resource from 18.5 million tons down to, I believe it was 11 or 12, to recognize and balance the indicated to inferred as we're trying to put shapes and look at potential economics. But that also has been able to tell us, okay, where do we need to add tonnage? Where do we need to convert grade to make that the end mine development more economic? So we are valuing indicated. We're taking an inferred that is on the boundary of the indicated, but then we're looking blue sky and looking at the full picture as a whole so that it helps influence how do we improve the pathway to delivering a robust PEA.
Right, okay. And you talk about, obviously, you inherited a lot of historic data here, and you're going through validating that. There's new holes going in. And in terms of that M&I, how much is that sitting in the historic, and how much have you been able to kind of top that up with your own drilling?
So when we started with the project, it was 11.5 million tons, and we've now been able to increase it to 25, with the indicated moving from what I believe was 7 now up to 12.5, or sorry, 13. So we've made a meaningful improvement in indicated. The last drill program was very much focused on inferred. With this year, again, it will balance. I think we're going to be still very focused on expansion, but we need, for looking out to our PEA, we need to continue to develop indicated. So it will be a balanced approach. And again, especially drilling within the model in areas that we see great improvement, like we did in the fourth quarter.
At what point do you need to start sort of drilling for, to kind of support, reserve numbers, because that may not be I guess a good enough return of invested capital at this stage. But at what point do you start looking at that?
I think the market rewards you for growth, and we want to make sure that we are balancing our cost of capital and where we're going to get the best return for shareholders. So if I was to allocate half of our budget to resource conversion this year, that's not what's going to get the market excited to move our market cap from 140 to 500. And we see the potential for that growth, but that growth is going to come from expansion. If we are able to make a standalone discovery, if we're able to consolidate other opportunities that build on scale to B26, those are the key movers. So I think we have to always balance where we're at and what our cost of capital is and what the market expectations is. And also looking at some of the goals and challenges that are given to us from some of the producers that are reviewing the project on what they want to see and what it's going to take for them to potentially move into a position of a strategic investment. So I think, again, as you said, depends on where we're at in our valuation, what the market is expecting of us, but at all times we are monitoring to ensure our capital goes to where it's going to put our shareholders in the best position of success.
Okay, Nick, as well as you can, I guess, picking this up at a extremely good price, one of the things which is very attractive is the kind of grades that we're used to hearing from you. But there's a kind of point where you've got to start doing these sort of trade-offs between sort of tonnage and kind of grade dilution, and trying to understand where that structurally starts to appear. So how are you thinking about that?
It's a great point, and that's part of the reason why I'm excited to have David Bernier that has joined the team. With his mine, he's built many mines in Saskatchewan, Ontario, Quebec, but it's almost a full-time team that is able to take the resource and run, okay, is there a pit? Is this a 2,000 ton per day and focus on the high grade? Is this a 4,000 to 5,000 ton per day pulling in all the low grade? There's a lot of things that go, there's a lot of things, as you know, that go in behind the scenes to deliver as robust of a strategy as possible. And that's why I'm excited for Dave to join the team. We have a very good exploration team, and now we have the team that has the mine building experience. Combining those two independent strategies again with each other puts us in the best position of success allocating capital with our end goal in mind of building a robust tier one deposit that that meets all of the check marks for development.
So he's going to focus, obviously, looking at how the different mining scenarios affect dilution. But for the kind of the exploration, the drill team, as it were, domain expansion or chasing after these high grade feeder zones, which you're seeing today, that's also going to affect things. So at what point does the decision making move more towards what does the mine look like versus currently, which is chasing these high grade feeder zones?
Well, I think it's two strategies that move in parallel. I think there's also a question of okay, we have one of our senior geologists working full time on upgrading our geological model because we are seeing very high grade material at depth with a very high gold credit. So is there something different with the gold at depth that could be offset from the copper? Is the end vision of the deposit, should we be subdomaining the high grade zones separate from the lower grade envelope? These are all questions that we're working on. And also, is the high grade material that we're seeing at depth and that we see near surface with a gap in between that is restricted by the drill grid, that we do need to do additional infill drilling to what I believe will be completing the high grade lens on the western side of the deposit, just like the east. But these are all scenarios that we have to run, and the importance of the geological model, because a stronger geological model can help us predict what the drill bit is going to tell us, and again help reduce our discovery costs, expansion costs, especially because we think and hope there could be a richer source of this more massive material at depth. So combining downhole geophysics in with it, really throwing everything around it. But I think getting back to your question, the resource is moving, bringing the mining methods into it is important to make sure that we continue to deliver stronger and stronger resources that tie into PEA and further stage economic studies.
So, but is there a hypothesis that you're kind of walking into that process with, in terms of whether it be like higher grade zones clustering, or does the system sort of disperse as it grows? You got to have a basic thesis initially, hypothesis initially, and then test that and evolve and change. What do you know today, I guess?
I think what we know today is we look at the Salbe mine that's 7 kilometers away. That was a 60 million ton deposit at 2%. Their later zones that they finished production with were closer to 3%. So similar to B26, Salbe had a 2% pretty consistent mineralization, which was produced over 20 years, but they came into higher grade zones. And we're studying that deposit to help influence help showcase what B26 could be, but it's a good benchmark of what this combination of lower grade and higher grade material could amount to, given how close by it is and sharing a lot of the same geological features as B26. So I think that's how we see it as of today. B26 does have a higher gold credit than Salbe. So it is similar, but there is some differences. But combining the geological model in with our mining studies, we're going to be able to continue to try to bring out a model that weighs all the options and puts the best one forward.
Okay, and you're obviously looking to kind of maintain those grades whilst expanding. Makes sense. Bit of commentary on the macro, if you don't mind. Obviously, we've seen in the last couple of weeks fairly volatile market in the sense that I think people expected prices to run and run. We had a little breather, shall we say, a little bit of a recovery, and then kind of another reset. So how do you view things like that when you're looking at metal prices? You're going to need to kind of work out what mineable tonnage, mineable tonnage material actually looks like. Any thoughts and expectations around that, and does that affect your decision making?
It doesn't affect our decision making. It's part of the reason why we ran our resource at $2,500 gold, $450 copper, $30 silver, because we don't need this market for this project to be successful. But we have an asset with the leverage that the economics and the value of this is even stronger in this market. And that's why we did it at a conservative baseline. We show the impact with spot commodity prices. So, but we're not basing decisions off of $5,000 gold or $6 copper. Our view as management is we are getting into an $8 copper environment. Gold is going to continue to perform, but we don't want to set an expectation to the market that we need that. It's again, our baseline is strong. The torque with commodity prices makes it even better. And I think that's what moves it to being a world-class opportunity at a time when producers are scrambling for assets. As I mentioned earlier, the Foran takeover of $4 billion, that is an asset that's resource was 44 million tons at 2%, just over 2%, inferred was under 2%, with a richer zinc credit. So we have, comparing the two resources together, we have 56% of that resource as of today. They had the Tesla zone, which wasn't counted, which I give them a lot of credit for. But at the end of the day, it shows how rare these are, how much leverage and growth could come from these VMS projects. And that's where, again, we're not making decisions with the commodity prices in mind, but it's what makes us very excited and taking a more long-term approach with how we allocate capital, because we think the market will continue to reward us.
Right. Do you think, if you're looking at the resource today, do you think that the kind of current resource relies on kind of byproduct credits, and can you sort of help shape and direct that as you say it today?
Well, I think this is a meaningful copper equivalent. There's companies that will take equivalent, shove everything in, cater it to the equivalent of the day, and they promote it. This is a meaningful copper equivalent where, just looking at some of the numbers, like the indicated has 1.19% copper, 1.6% zinc, 0.44 grams per ton gold, 31 grams silver. So it's meaningful components across all categories. But the exciting thing about inferred is at 1.6% copper and 0.67 grams per ton gold. So, and again, what it ends up coming together is 775 million pounds of copper, 451,000 ounces of gold, 60 million ounces of silver, 376 million pounds of zinc. But what does that mean? This is why the producers are looking for copper gold, especially VMSs, because it has, like you look at LaRonde, I remember seeing some studies that the zinc and copper paid for OPEX and the gold was a bonus at times in the mine. So with commodity prices, precious metals prices moving, you have the hedge of being able to produce multiple commodities that sometimes some of them will end up being free at the end of the day. So I think that torque is something that we're excited about, and I think, as a lot of the producers have stated, is one of the most highly sought after deposits in the market.
Okay, eventually. In terms of obviously you're in the middle of drilling. You've got a decent balance sheet at the moment. If I'm looking to 2026, what are the kind of key deliverable moments? There seems to be you were ramping up all last year. This year you've got the money to do whatever you want to do. So what is it that you think is going to be the best allocation of capital for 2026?
So I think it's a combination of continuing to grow the resource, continue to convert indicated. What we're really excited about this quarter is our first standalone regional drill program outside of the B26 deposit, testing at least 4 targets between B26 and the historical Salbay mine. If we're able to make a grassroots discovery, the market is going to say, how much bigger could this be? So I think we're very excited about that. Balancing the risk and reward, drilling 5,000 meters on regional, and using downhole geophysics on each of the holes on the targets, and then following up right away if we have any success. We're also going to be putting forward a meaningful scoping baseline permitting budget for this year to be able to de-risk and work on our social licenses, to build out our strategy of where we want to be. The sooner you start that, the more long-term beneficial it is. And it's also what a strategic producer wants to see. They don't just want to see us drilling expanding, but there's a whole other bucket that comes along with how a project, what needs to be there for a project to be successful. So I think our budget is set for this winter. Our overall budget is set for the year. With Dave joining about a month ago, we're still building out our development side of our budget for this year, but you're going to see a balanced approach across resource expansion, infill, regional, and early stage development work for this year, combined with the exercise of our option agreement at B26, and hopefully the expansion of adding on additional nearby projects to expand the scale within this camp.